Exchange traded funds, or ETF, are a hugely popular way of investing, and for good reason. They're cheap, they're easily accessible, they're highly liquid, they're very diversified, and you can start investing in ETFs with just a little bit of money. And for these reasons, I tend to incorporate ETFs in all of my portfolios. As the popularity of ETFs has increased over the years, so have the type of ETFs that are available. Back when they were first created in '93, you could basically say that an ETF is an investment which tracks an index, but today there's so much more to it than that. So in today's video, I really want to go over the different types of ETFs available and give you the pros and cons of each. Hello guys, Brad here from The Guided Investor. Welcome back to the channel. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. So ETFs, let's kick things off with a proper explanation of what an ETF is. So an ETF is a pool of investments held in a trust structure which you can access through a stock exchange. Now, put more simply, an ETF is a bucket. And in that bucket are assets. Now, most of the time the assets are shares, but they can be other things like commodities, currency, bonds, etc. You buy an ETF like you buy any other share listed on the stock exchange, so you'd normally use an online broker account. Now, when you buy into an ETF, you essentially add to that bucket and you get exposure to all of the underlying assets held within the bucket. So now that we know what an ETF is, let's look at the different management styles. So basically, when I say management style, I'm talking about how the assets in the bucket are selected. And then broadly speaking, there's three different types of management styles. You've got passive, active, and smart beta. A passive ETF is simple because it just tracks an index. Plain Jane boring, but it gets the job done. So for example, when you buy an ETF which tracks the ASX 300, you're essentially getting exposure to every single company listed in the top 300 on the ASX. The amount of exposure you get to each stock is going to depend on the market capitalization of the stocks, which is basically a fancy way of saying the size of the stock. So if you're getting the ASX 300, you're going to get the most exposure to CSL, as that is currently the biggest company. You're going to get the second most exposure to CBA, as that's the second biggest company, and so on. Passive ETFs are the more traditional style ETF, and they are great for the following reasons. Firstly, they're very cheap. All the trading is done by computers with no human intelligence involved in the stock selection, which keeps the costs down low, really low. The management costs of a passive ETF generally lie between 0.03% and 0.4% per annum. They're well diversified. You're getting the exposure to the entire index through a single holding. This is a great way to get diversification in your investments, and we all know diversification is key. Passive investing often outperforms over the long run. A study completed by Morningstar shows that 77% of active fund managers actually underperform their benchmark over a 10-year period. Even Warren Buffett, one of the greatest active managers of all time, recognized this when he famously made a $1 million bet with Protégé Partners back in 2008 that they wouldn't outperform the S&P 500 index over a 10-year period. Well, he won that $1 million bet and collected in 2018. So there are a lot of benefits of passive ETFs, but like with every investment, there are downsides as well. So let's look at some of the cons of a passive ETF. You'll only ever get a beta return. So a beta return is a return that's 100% correlated with the market. For example, if the market goes up by 10%, you make 10%. If the market goes down by 10%, you lose 10%. Now, many investors actually like to try and outperform the relevant index. You may be getting overweight exposure to particular stocks. So as the level of exposure is determined by the market capitalization of the underlying stocks, there is a good chance that you'll be overweight in some holdings. So for example, take the ASX 300 again. It's dominated by the top 10 holdings, which make up roughly 44% of the index. So although you're getting exposure to 300 stocks in total, the amount of exposure to those companies outside the top 10 is quite minimal. There is an inability to target specific portfolio outcomes. Now, many portfolios developed with an investment objective in mind. So for example, you might need income. So you want a dividend producing portfolio which is 100% franked. You can't do this properly with a passive ETF, as you'll generally get a lot of low yielding stocks in the portfolio along with the big cash payers. So there are a few things to consider there, but overall, passive ETFs are a great option for many investors. You get a lot of diversification at a very low cost, and historically they've performed pretty well. So for me, that means passive ETFs earn their spot as the backbone of many portfolios. As the name suggests, an active ETF has active management going on behind the scenes. So they've still got the same bucket structure, but instead of the assets in the bucket being determined by an index, they're actually determined by a portfolio manager and their team, which hand select those assets. So for example, you might have an active ETF that only invests in Australian stocks, but their mandate is to produce a high income. So they're actively going out and selecting stocks on the ASX which produce a high dividend yield and a good franking level. The benefits of actively managed ETFs include the following. You get exposure to fund managers' expertise. Now remember that we said overall statistics show that 77% of fund managers don't outperform the index over a 10-year period. Well, if you select the 23% that does, then you're going to get a better return than a passive investor. You get the ability to better target portfolio objectives. So for example, I don't like passive investment in the fixed income space, as I like more control over duration and fixed versus floating rates, so therefore I tend to only use active management to achieve this. A passive ETF would not suit my needs as its index-based mandate is too broad. Active managers can hold cash. In a market downturn, like we've seen recently, it is beneficial to have some cash in your portfolio so you can not only reduce your downside risk exposure, but also buy more assets when they are cheap. Active managers can make these calls, and provided they get the call right, this can generate some good outperformance as a result. Again, plenty of benefits with active management, but they do come with some downsides. Firstly, there's increased costs. Investment decisions are made by people, not computers, so they charge for their time and expertise, which is represented in the management fee. The management fee of an active ETF is often well in excess of double that of a passive ETF, so the manager needs to outperform by at least their costs to get the same return for investors. Active managers often don't outperform the index. We've looked at the numbers, 77% will likely not outperform the index over a 10-year period. So don't expect that alpha return on your money just because you're paying a premium for active management. Active ETF managers often don't disclose their full portfolio holdings. What this means is that you don't actually know exactly what is in the bucket you're buying into. Often it's only the top 10 holdings that are disclosed to investors. Now, this isn't the manager being deceptive, it's them protecting their intellectual property. They don't want other people copying their ideas. So if you're someone that needs to know everything about investment, then maybe an active ETF isn't for you. So that's active ETFs, and again, I really like active ETFs. Now, I use them in my portfolios not only to try and generate that alpha type return, but also to target specific portfolio objectives. The last type of ETF I want to look at are called smart beta ETFs. And these are ETFs which use a rule-based approach to determine what goes into the bucket. I guess you could argue that they're a hybrid between active and passive management, but essentially there's a screening process that goes on behind the scenes to determine what assets they invest in. So let me give you an example. One type of smart beta ETF is an equal weight ETF. Now remember when I said if you buy the ASX 300 index, you're getting a lot of exposure to the top 10 companies listed on the ASX. Well, you could overcome this with an equal weight ETF. An equal weight ETF doesn't care about the market capitalization of a stock or the size of the stock. Instead, it will give you equal weight to all of the companies listed in their mandate. And this basically spreads out the load. So instead of getting a lot of exposure to the big blue chip companies and very little exposure to those mid caps, you're getting the same exposure to both. So the benefits of a smart beta ETF are as follows. There is a potential for outperformance. As with active management, rules-based management gives you the potential to outperform the relevant index. Again, this is not guaranteed, but it does give you that portfolio alpha that a lot of investors search for. Smart beta ETFs are generally cheaper than active management. As the manager simply sets the rules and lets the computer do the rest, it's less hands-on. This allows the fund manager to provide the product at a cheaper cost. Smart beta ETFs usually charge a management fee somewhere between passive and active management. You get the ability to target portfolio objectives. Like with an active ETF, you can choose a smart beta ETF which has a rules-based approach which is in line with your preferred investment method. So this allows you to target particular portfolio outcomes provided you find the right rules-based approach. As with the other two types of ETFs, smart beta ETFs have some things to consider before you invest, and they are as follows. They're not as cost effective as a passive ETF. Although there's not a whole lot of human intelligence involved in this form of ETF, there is still a little. As a result, the cost is often slightly higher than that of a passive ETF. There are no guarantees that you will outperform the index. Just because there is a rule-based approach behind the scenes, that doesn't mean that it's going to outperform. Again, statistics suggest that it's very hard to outperform the index, and this applies to rule-based investing as well. So I really like smart beta ETFs too, and I use them in my portfolio where required. And I actually like all the styles of ETFs, and I use them all in the appropriate circumstances. For me, ETFs really should form the backbone of a portfolio with a little bit of alpha sprinkled around the edges to try and get that outperformance. If you are thinking about investing in ETFs, try to stick to the key players out there. There are some ETF providers that don't actually own the underlying stocks or the assets in the bucket. Instead, they use derivatives and swaps to just replicate it. And for me, this just adds extra risk, which you don't need to take. But that's it for me, guys. Thanks for watching. Let me know in the comments section below which of the three types of ETFs is your preference, and I will see you guys in the next video.